I've received a lot of questions in my previous videos from fresh beginners who are just starting trading for the first time, and many other wise questions from day-to-day traders who have been in the game for a while. A lot of these questions are very important that if ignored will really become a burden and draw down in your trading journey. And that is the reason I made this video, to explain everything about Forex trading once and for all. If there is any question you have had in mind to ask and learn, as you watch this video with undivided attention, you will find all the answers to your question. The first wise approach to everything in life is to first of all understand the name and character of what you're dealing with. You need a very rich information packed with all you need to know before taking your steps, as only that will guide you and tell you the depth of the problem you're dealing with. A lot of people will tell you, trading is risky, trading is hard, only 80% of traders make money, and a lot of words to fail your psychology. While some of these things can be true, it is also very important to wear the full armor for your trading success. Imagine you are in a jungle, in the middle of nowhere, lost and stranded. Then as you begin to move around, you begin to discover strange things which you are unfamiliar with, leading to fear and confusion. But let's imagine you are with a gadget, and the gadget tells you the name of where you are, somewhere known to be peaceful. Your fear and confusion begins to reduce. But if the gadget tells you that you are in a jungle, filled with lovely deadly snakes, some friendly hungry crocodiles, lions and some beautiful leopards, or fierce rats, your fear begins to rise tremendously. You don't want to be bit by snakes, or maybe to embrace the warmth welcome of the lions. But if, as though you know the informations about the place forehand, and you came prepared and equipped with all the safety measures and tools needed, your confidence becomes strong in your safety tools, and almost all your fears will be diminished. The level of information taught and communicated to you is what really moves you while you are trading. If someone tell you Forex trading is very easy, and you can make money easily by just clicking the buy and sell button at will, and profits will start flowing joyfully into your trading account, and you'll buy a Lamborghini, the latest Rolex wristwatch, and enjoying life with the most beautiful women on a beach of paradise. You can be lost in those your imaginations and start actually buying and selling at any point. You may be lucky at first when you clicked the first buy button. It gave you big profits. There is so much excitement in your blood system, flowing through your medulla, but after a little while, you will realize that the light you saw at the end of the tunnel was actually darkness. That's when it dawns on you that nothing in Forex trading is born out of luck. It's full of process. Then you begin to seek better information to help you efficiently exploit the market. Scrolling through your charts every day, without knowing the informations that guide what you are doing or trading, is like being stuck in that jungle without the right equipment. The beautiful lions and snakes of the Forex trading jungle will celebrate a big bazaar and after party with all your portfolio, and they won't leave a single dollar behind. This video is divided into 3 sections. In section 1 you will learn the history of Forex trading, general terminologies, Forex structures, and how to use trading tools. This entails what is Forex and a brief history of Forex. Why should you even trade Forex? What are currency pairs? How currency pairs form, major and minor pairs. What are pips? How to calculate pips. About leverage. What are spreads? Types of Forex orders. How to place buy and sell orders. The difference between equity and balance. What is liquidity? What is volatility? How to know the best lot size to use for an account. How to set up MT5 on your mobile phone. How to set up MT5 on your Windows. How to set up Trading View for your phone. And common Trading View tools and how to use them. In section 2, you will be learning on technical analysis and price action. This entails technical analysis and market structure, support and resistance, trend lines, supply and demand, chart patterns, candlestick anatomy, candlestick patterns, trading time frames, types of Forex traders, market participants, bulls and bears, indicators, Forex market hours trading sessions, simple common mistakes to avoid while trading. In Section 3, you'll learn about brokers, how they work, and trading psychology. This entails who are brokers, how the brokers work, 5 criteria for choosing a good broker, Forex news, backtesting, trading psychology, how to manage your risk. If you're watching our video for the first time, subscribe and turn on notifications to make yourself part of the family. Everything you need to know about Forex trading is in this video. May the good Lord Jesus help you to understand perfectly everything you're about to learn and give you great knowledge to soar in this trading journey. Forex is an abbreviation which means foreign exchange. The foreign market is a global marketplace for exchanging national currencies. Because of the worldwide reach of trade, commerce, and finance, Forex markets tend to be the world's largest and most liquid asset markets. Forex trading, also known as FX trading or currency trading, is the act of buying and selling currencies with the intention of profiting from the changes in their exchange rates. The Forex market is the largest and most liquid financial market in the world, with an average daily trading volume exceeding $6 trillion, with trading occurring 24 hours a day, 5 days a week. Forex trading has its roots in ancient times, when people exchanged goods and services for other goods and services. As societies evolved, so did the methods of trade, eventually leading to the use of currencies. The modern Forex market, however, has its origins in the early 20th century. Before the modern Forex market, the gold standard was prevalent. Countries would fix the value of their currency to a specific amount of gold, creating a system of fixed exchange rates. The gold standard system traces its origins back to ancient times, when gold was used as a medium of exchange and a store of value. It gained prominence during the 19th century as countries sought to establish stable currencies to facilitate international trade. Under the gold standard, countries fixed the value of their currency to a specific weight of gold. For example, if the exchange rate was set at $20 per ounce of gold, then the value of a currency unit, for example, dollar, was equivalent to a specific amount of gold. One of the key features of the gold standard was convertibility. This meant that individuals and foreign governments could exchange their currency for gold at a fixed rate. Convertibility instilled confidence in the currency and provided stability to the monetary system. The gold standard offered several advantages, including price stability, as the supply of gold grew slowly, preventing rapid inflation. It also promoted fiscal discipline among governments, as they were required to maintain sufficient gold reserves to back their currency. Despite its advantages, the gold standard had limitations. The supply of gold was limited by natural factors, such as mining output, leading to constraints on economic growth. Moreover, adherence to the gold standard sometimes forced governments to adopt deflationary policies during economic downturns, exacerbating recessions. The gold standard began to decline in the early 20th century due to various factors, including the cost of maintaining gold reserves, the outbreak of World War I, and the Great Depression. Many countries abandoned the gold standard during the interwar period to pursue expansionary monetary policies to combat economic crises. Following World War II, the Bretton Woods Agreement established a new international monetary system, which maintained fixed exchange rates but pegged currencies to the US dollar instead of gold. The Bretton Woods Agreement was negotiated during the United Nations Monetary and Financial Conference held in Bretton Woods, New Hampshire, USA, with representatives from 44 allied nations in attendance. The primary goal was to create a stable international monetary system to promote post-war economic reconstruction and prevent the economic turmoil that had characterized the interwar period. One of the central features of the Bretton Woods system was the establishment of fixed exchange rates, where currencies were pegged to the US dollar, and the US dollar was pegged to gold. This system intended to provide stability and facilitate international trade by reducing currency volatility and facilitating international monetary cooperation. The agreement also led to the creation of the International Monetary Fund, IMF, which was tasked with overseeing the new monetary system, promoting exchange rate stability, providing financial assistance to member countries facing balance of payments problems. Additionally, the agreement established the International Bank for Reconstruction and Development, known as the World Bank, to provide financial assistance for post-war reconstruction and development projects, particularly in war-torn countries. Under the Bretton Woods system, the US dollar became the primary reserve currency, with other currencies fixed to it at predetermined exchange rates. This arrangement was possible because the United States held the largest gold reserves and had a relatively stable economy compared to war-torn Europe and Asia. While currencies were fixed to the US dollar itself was convertible to gold at a rate of $35 per ounce. This gold convertibility provision provided confidence in the US dollar and the Bretton Woods system as a whole. The Bretton Woods system operated relatively smoothly in the immediate post-war period, contributing to the economic recovery and growth of many countries. In August 1971, US President Richard Nixon unilaterally suspended the convertibility of the US dollar to gold, effectively ending the Bretton Woods system. This event, known as the Nixon shock, marked the beginning of the era of floating exchange rates and paved the way for the modern Forex market. Despite its eventual collapse, the Bretton Woods Agreement left a lasting legacy in shaping the post-war international economic order. Elements of the agreement, such as the IMF and World Bank, continue to play significant roles in international finance and development, while debates about exchange rate regimes and monetary cooperation persist in contemporary economic discussions. One of the primary factors leading to the collapse of the Bretton Woods system was the accumulation of US dollars by foreign countries under the fixed exchange rate regime. Countries held US dollars as reserves due to its convertibility to gold at a fixed rate of $35 per ounce. The Bretton Woods system relied on balanced trade among member countries to maintain stable exchange rates. However, by the late 1960s, imbalances in trade and capital flows emerged, with the US running large trade deficits while other countries accumulated dollar reserves. This imbalance put pressure on the fixed exchange rate system and strained international monetary relations. As doubts grew about the viability of the Bretton Woods system, investors and speculators began to doubt the ability of central banks to defend their fixed exchange rate commitments, leading to destabilizing currency movements and volatility in foreign exchange markets. To maintain the fixed exchange rates, central banks intervened in currency markets by buying or selling their own currencies. However, as the US dollar came under pressure, central banks began to redeem their dollar reserves for gold, depleting US gold reserves. This loss of gold reserves further undermined confidence in the US dollar and the Bretton Woods system. On August 15, 1971, US President Richard Nixon announced a series of economic measures, collectively known as the Nixon shock, which effectively ended the convertibility of the US dollar to gold. This decision, known as the closing of the gold window, marked the official collapse of the Bretton Woods system and the beginning of the era of floating exchange rates. With the collapse of the Bretton Woods system, currencies were allowed to float freely against each other, with their values determined by market forces of supply and demand. This transition led to increased exchange rate volatility, but also provided greater flexibility for policymakers to pursue independent monetary policies tailored to domestic economic conditions. The emergence of electronic trading revolutionized financial markets, including the Forex market, by introducing faster, more efficient, and accessible ways to trade currencies. Electronic trading traces its roots back to the 1960s and 1970s with the introduction of computerized trading systems, such as the New York Stock Exchange designated order turnaround system. These early systems facilitated order routing and execution, but were limited in scope and accessibility. The widespread adoption of computers and telecommunications technologies in the 1980s and 1990s laid the groundwork for the development of electronic trading platforms. Improvements in processing power, network infrastructure, and data transmission capabilities made it feasible to execute trades electronically in real time across different markets and time zones. The Forex market was one of the first financial markets to embrace electronic trading due to its decentralized nature and 24-hour trading cycle. Electronic communication networks (ECN) and trading platforms emerged to connect buyers and sellers directly, bypassing traditional intermediaries such as banks and brokers. ECN are electronic platforms that enable participants to trade directly with each other, anonymously. They aggregate buy and sell orders from multiple sources and match them based on price and size, providing liquidity and transparency to the market. ECN also offer features such as real-time quotes, order book visibility, and algorithmic trading capabilities. Electronic trading platforms such as MetaTrader, CTrader, and Bloomberg Terminal provide traders with access to the Forex market through user-friendly interfaces and advanced trading tools. These platforms offer features such as charting and technical analysis tools, customizable order types, risk management functions, and access to news and market analysis. The rise of electronic trading paved the way for the proliferation of high-frequency trading, HTF strategies, where traders use sophisticated algorithms and computer programs to execute trades at ultra-fast speeds and high frequencies. HFT has become a dominant force in financial markets, including the Forex market, accounting for a significant portion of trading volume. Electronic trading has democratized access to financial markets, allowing individual retail traders to participate alongside institutional investors on equal footing. Retail traders can now trade Forex from anywhere in the world using a computer or mobile device, with access to real-time market data, execution speeds, and competitive pricing. As electronic trading has grown in importance, regulators have implemented rules and regulations to ensure fair and orderly markets. Regulatory oversight covers areas such as trade execution, market transparency, cybersecurity, and investor protection. Now you and everyone, from everywhere around the world, can start trading with their laptops and even their mobile phone at any time they choose between the trading hours. Now the question is, though the Forex market comes with a high risk, here are some few reasons I will advise anyone to trade Forex. 1. The Forex market is the largest and most liquid market in the world, with a daily trading volume exceeding $6 trillion USD. High liquidity means traders can enter and exit positions easily without significant price movements, reducing the risk of slippage and improving trading efficiency. 2. Forex trading is accessible to individuals with various levels of capital and experience. Unlike other financial markets, such as stocks or commodities, which may require substantial capital or specialized knowledge, Forex trading can be started with relatively small amounts of money and accessed through online brokers and trading platforms. 3. Unlike stocks and some other commodities, The Forex market operates 24 hours a day, 5 days a week, allowing traders to participate in trading activities at any time of day or night, regardless of their location. This flexibility is particularly advantageous for traders who have other commitments or prefer to trade outside of the regular market hours. 4. Forex trading provides opportunities for profit in both rising and falling markets. Traders can profit from changes in exchange rates by buying going long or selling going short on currency pairs, depending on their market outlook and trading strategy, with proper analysis and risk management. Traders can capitalize on price movements and generate consistent returns over time. 5. Forex trading offers opportunities for portfolio diversification, allowing traders to spread their investment across different currency pairs and assets. This diversification helps to reduce overall portfolio risk by balancing losses in one position with profits in another. 6. Unlimited access to tools and resources. Many Forex brokers and trading platforms offer a wide range of tools, resources, and educational materials to help traders improve their skills and make informed trading decisions. These resources may include charting and technical analysis tools, economic calendars, news feeds, educational articles, webinars, and demo accounts for practice trading. All this helps you to profit and manage your risk in the market, making sure you stay up to date with events and giving you all the necessary tools to elevate your game. Currency pairs are the foundation of Forex trading and represent the relationship between two different currencies. In Forex trading, currencies are always quoted in pairs because when you trade one currency, you are simultaneously buying one currency and selling another. Each currency pair consists of a base currency and a quote currency, and the exchange rate indicates how much of the quote currency is required to purchase 1 unit of the base currency. For example, in the Euro-USD currency pair, Euro is the base currency. US dollar is the quote currency. If the exchange rate for Euro-USD is 1.2000, it means that 1 euro is equivalent to 1.2000 US dollars. If you buy the Euro-USD pair, you are buying euros and selling an equivalent amount of US dollars. There are 3 main types of currency pairs. 1. Major pairs. Major currency pairs are the most heavily traded pairs and involve the world's most liquid currencies. The major pairs include 1. Euro and US dollar. 2. US dollar and Japanese yen. 3. British pound and US dollar. 4. US dollar and Swiss franc. 5. Australian dollar and US dollar. 6. US dollar and Canadian dollar. 7. New Zealand dollar and US dollar. 2. Minor pairs. Minor currency pairs, also known as cross-currency pairs, do not include the US dollar. They consist of major currencies traded against each other. Examples include 1. Euro and British pound. 2. Euro and Japanese yen. 3. British pound and Japanese yen. 4. Australian dollar and Japanese yen. 5. New Zealand dollar and Japanese yen. 0.6. Euro and Australian dollar. 3. Exotic pairs. Exotic currency pairs involve one major currency and one currency from a developing or emerging market economy. These pairs typically have lower liquidity and higher spreads compared to major and minor pairs. Examples include 1. US dollar and Turkish lira. 2. US dollar and South African rand. 3. Euro and Turkish lira. 4. US dollar and Singapore dollar. 5. US dollar and Hong Kong dollar. In Forex trading, a pip stands for percentage in point or price interest point. It represents the smallest price movement in the exchange rate of a currency pair. Most currency pairs are quoted to 4 decimal places, except for some pairs involving the Japanese yen JPY, which are quoted to 2 decimal places. For example, if the Euro USD exchange rate moves from 1.2000 to 1.2001, it has moved 1 pip. If the USD JPY exchange rate moves from 109.50 to 109.51, it has also moved 1 pip. The exception is for currency pairs involving the Japanese yen JPY. In these pairs, a pip is represented by the 2nd decimal place instead of the 4th. Another example is, if the Euro JPY exchange rate moves from 130.00 to 130.01, it has also moved 1 pip. Pips are used to measure price movements and calculate profits and losses in Forex trading. The value of a pip depends on the size of the position, known as the lot size, and the currency pair being traded. How to calculate profit or loss in pips. To calculate profit or loss in pips, you need to know the pip value of the currency pair and the number of pips gained or lost. Multiply the number of pips gained or lost by the pip value to calculate the profit or loss in the base currency of the trading account. Calculating pips in Forex trading depends on the decimal placement of the currency pair's exchange rate and the direction of the price movement. Here's how to calculate pips. For currency pairs with 4 decimal places, that is most pairs except 4 JPY pairs, to calculate the number of pips when the exchange rate increases, subtract the initial exchange rate from the new exchange rate. To calculate the number of pips when the exchange rate decreases, subtract the new exchange rate from the initial exchange rate. The result will be the number of pips. In order to calculate the initial profit or loss you will make in your trading account, here is how to do it. Let's say Euro USD pair rose from an initial exchange rate of 1.2001 to 1.2080. That will be 1.2080 minus 1.2001, which will give us 79 pips. Now multiply the 79 pips with the lot size which you will be using for the trade. Let's imagine you are using 0.8 lot size to trade. That will be 79 multiplied by 0.8. The result is your profit. This means your profits will be $63.2. If the Euro USD pair falls from 1.2090 to 1.2002, that will be 1.2090 minus 1.2002, which will give you 88 pips. 88 pips multiplied by 0.8 lot size will give you a profit of $74. You can use these strategies to calculate your take profit and stop loss levels too. Here is another simple way to do it. Go to the MetaTrader app and select the cross line. Hold it with a finger on the start of your interest point, and then use another finger to extend it to your last point of interest. You will see 2 values. The first one is the number of candlesticks bars, while the second is your pip value. The digits after the zeros represent your pip value. Now you can multiply it with the lot size you're trading with to know what your profits or loss will be. Leverage in Forex trading refers to the ability to control a larger position with a smaller amount of capital. It allows traders to magnify their potential profits and losses by borrowing funds from their broker to open positions larger than their initial investment. Leverage is expressed as a ratio, such as 50-to-1, 100-to-1, or 500-to-1, representing the amount of capital that can be controlled relative to the trader's own funds. Here's how leverage works in Forex trading. For example, let's say you have $1,000 in your trading account and your broker offers a leverage ratio of 100 to 1. With this leverage, you can control a position size of up to $100,000, even though you only have $1,000 of your own capital. Leverage magnifies both potential profits and losses. If the price moves in your favor, your profits will be amplified relative to the size of your initial investment. However, if the price moves against you, your losses will also be magnified, and you could potentially lose more than your initial investment. When using leverage, traders are required to maintain a certain amount of capital in their trading account as collateral, known as margin. Margin requirements vary depending on the leverage ratio and the size of the position. Brokers typically specify the margin requirement as a percentage of the total position size. If the value of your trading account falls below the required margin level due to losses incurred on leveraged positions, your broker may issue a margin call. A margin call requires you to deposit additional funds into your account to meet the margin requirements, or close out some or all of your positions to reduce the risk of further losses. Leverage in Forex trading is subject to regulatory limits imposed by financial authorities in different jurisdictions. These regulations aim to protect retail traders from excessive risk and ensure the stability of financial markets. Regulatory limits on leverage vary by country and may restrict the maximum allowable leverage ratios that brokers can offer to retail clients. Spread refers to the difference between the bid price and the ask price of a currency pair. It represents the cost of executing a trade and is typically measured in pips. Here is how spreads work. The bid price is the price at which the market is willing to buy a currency pair from you. It is always lower than the ask price. When you sell a currency pair, you will receive the bid price. The ask price is the price at which the market is willing to sell a currency pair to you. It is always higher than the bid price. When you buy a currency pair, you will pay the ask price. The spread is the difference between the bid price and the ask price. It represents the broker's profit and covers their costs of providing liquidity and executing trades. The tighter the spread, the lower the cost of trading for the trader. Spreads can be either fixed or variable. Fixed spreads remain constant regardless of market conditions, while variable spreads may widen or narrow depending on factors such as market liquidity, volatility, and news events. Spreads tend to be tighter for major currency pairs, which are the most heavily traded pairs and have high liquidity. Exotic currency pairs, which involve currencies from smaller or emerging market economies, may have wider spreads due to lower liquidity and higher volatility. Spreads directly affect the cost of executing trades in the Forex market. Traders aim to minimize the impact of spreads on their trading profits by choosing brokers with competitive spreads, trading during times of high liquidity when spreads are typically tighter, and using strategies that are less sensitive to spread costs. There are several types of orders that traders can use to enter or exit positions in the market. These orders allow traders to execute trades at specific prices or under certain conditions. Here are the main types of Forex orders. 1. Market order. A market order is an instruction to buy or sell a currency pair at the best available price in the market. It is executed immediately at the current market price. Market orders are typically used when traders want to enter or exit positions quickly and are willing to accept the prevailing market price. 2. Limit order. A limit order is an instruction to buy or sell a currency pair at a specified price or better. It allows traders to set a target price at which they are willing to buy a trade. That is by limit order, or sell a trade, known as sell limit order. 3. Stop order. A stop order, also known as a stop-loss order, is an instruction to buy or sell a currency pair at a specified price or worse. It is used to limit potential losses by automatically closing a position if the market moves against the trader's position. Stop orders are commonly placed below the current market price for long position and above the current market price for short positions. 4. Stop limit order. A stop limit order combines features of both stop orders and limit orders. It consists of two components, a stop price and a limit price. When the market reaches the stop price, the order becomes a limit order, and it is executed at the specified limit price or better. Stop limit orders are used to control the price at which a trade is executed and to manage risk. 5. Trailing stop order. A trailing stop order is a dynamic stop-loss order that adjusts automatically as the market price moves in favor of the trader's position. It is set at a certain distance in pips or percentage from the current market price. If the market price moves in the trader's favor, the trailing stop order moves with it, locking in profits. If the market price moves against the trader's position, the trailing stop order remains stationary until the market reaches the stop price, and at that point the position is closed. 6. OCO order. OCO means one cancels the other. An OCO order is a combination of two orders, a buy limit order and a sell limit order. It allows traders to set both a profit target and a stop-loss level simultaneously. If one order is executed, the other order is automatically cancelled. That is why the name is called one cancels the other. All these Forex orders are used for different purposes, depending on traders' knowledge of trading the market, and they all come with their advantages and disadvantages. Always use the best order type that is best for the trade at the moment. To place an order, you open your Forex trading platform and log into your trading account using your username and password. Choose the currency pair you want to trade from the list of available pairs. For example, if you want to trade Euro USD, select this pair from the platform's drop-down menu. Most trading platforms have an order entry window or ticket where you can input the details of your trade. Locate the order entry window for the selected currency pair. This window typically includes fields for setting the trade size, order type, price, and other parameters. Determine the size of your trade by entering the number of lots or units you want to buy or sell. You can select from standard lots, mini lots, or micro lots based on your trading preferences and risk management strategy. Choose the type of order you want to place. Market order: execute the trade immediately at the current market price. For limit order, set a target price at which you want to enter the trade. The trade will only be executed if the market reaches this price or better. For a stop order, set a price at which you want to enter the trade, similar to a limit order, but with the expectation that the market will continue moving in the direction of your trade. Double-check the details of your order, including the currency pair, trade size, order type, and price. Ensure that everything is correct before confirming the order. Once you're satisfied with the order details, click the Buy or Sell button to place the order. If you're using a limit or stop order, the order will be held by the platform until the market reaches the specified price. After placing the order, monitor the trade's progress on your trading platform. When you're ready to close the trade, use your trading platform to close the position manually or set automatic exit orders, such as stop loss or take profit orders. The balance of a Forex trading account refers to the total amount of funds deposited into the account, including both the initial deposit and any former deposit or closed profits. The balance reflects the total amount of money available for trading. Equity, also known as account equity or trading equity, represents the current value of the trader's account, taking into account both the balance and the unrealized profits or losses from open trades. Equity is calculated by adding the balance and the unrealized profits, if positive, or subtracting the unrealized losses, if negative, from open positions. Equity fluctuates continuously as the market price of assets changes until the trades are closed. Liquidity in Forex trading refers to the ease with which a currency pair can be bought or sold in the market without causing significant price movements. It represents the depth of the market and the ability to execute trades quickly and efficiently at stable prices. In simpler terms, liquidity refers to how liquid or easily tradable a currency pair is. Here are the key aspects of liquidity in Forex trading. 1. High liquidity. Currency pairs with high liquidity have a large number of buyers and sellers actively trading in the market. These pairs typically have tight bid-ask spreads and high trading volumes. Major currency pairs such as Euro USD, USD JPY, and GBP USD are known for their high liquidity due to their popularity and widespread trading activity. 2. Low liquidity. Currency pairs with low liquidity have fewer market participants and lower trading volumes. These pairs may have wider spreads and are more prone to price slippage, where orders are executed at less favorable prices due to limited liquidity. Exotic currency pairs and currency crosses involving less traded currencies often exhibit lower liquidity compared to major pairs. Factors affecting liquidity. 1. Market hours. Liquidity tends to be highest during overlapping trading sessions when multiple financial centers are open simultaneously, such as the London-New York and Tokyo-London sessions. 2. Economic releases. Major economic events and data releases can impact liquidity by attracting increased trading activity and volatility. 3. Market participants. Institutional investors, central banks, hedge funds, and other large players contribute to market liquidity with their massive trading volume. Liquidity is very important for efficient price discovery, order execution, and risk management in Forex trading. High liquidity provides traders with tight spreads, minimal slippage, and faster trade execution, while low liquidity can lead to wider spreads, increased trading costs, and difficulty entering or exiting positions. Volatility in Forex trading refers to the degree of fluctuation or variability in the price of a currency pair over a certain period of time. It measures the rate and magnitude of price changes and reflects the level of uncertainty or risk in the market. In simpler terms, volatility indicates how much and how quickly prices move up or down. Here are key aspects of volatility in Forex trading. Currency pairs with high volatility experience large price movements over short periods. High volatility pairs are characterized by rapid and unpredictable price swings, which can present big opportunities and risks for traders. High, volatile market conditions usually results from economic news and geopolitical events. Currency pairs with low volatility have relatively stable price movements and smaller price fluctuations. Low volatility pairs tend to exhibit smoother and more predictable price trends, making them less risky, but potentially less profitable for traders. Low volatility occurs during periods of low trading volumes, consolidation, or market indecision. Some currency pairs may have consistent levels of volatility throughout the trading day, while others may experience spikes in volatility during specific trading sessions or news events. Learning the best lot size to use for your trading account is a very wise approach for risk management. You can't just dive into the market and start placing trades with any lot size on your trading account. This will take you out of a good trade very early before you even start making profits. To know the best lot size to use for your trading account, you should follow these process carefully. Here is a step-by-step guide for you to determine that. The first step is to consider the size of the account that you want to trade. This will be your guide to anything you are looking for. The second step is to really understand and frame your strategy and risk management level. For instance, your planned stop-loss level for each trade is 20 pips. Now you have to calculate how much you will lose on a single trade. Take this for an example. Let's imagine you have a $50 account and your maximum target loss on a single trade is $10. So now you must define a lot size that will suit your trading risk plan. The third step is to check for the smallest lot size. Then begin to calculate it with the value of the pips you plan to risk for each trade. You can calculate it using the strategy I showed you earlier on how to calculate profit and loss with pips. Now multiply the value of the lot size you want to use with the pip value. If it incurs more loss, reduce the lot size and multiply it again. If the lot size is not giving you a value up to your target loss, increase the lot size and multiply it again. Keep doing this till you get the right lot size for your trading risk. Every lot size you choose for your account will determine the amount of loss and profit you will make. You can also do this to determine the exact amount you will make from your take-profit target. To set up MetaTrader 5 on your phone, you head over to Google Play Store and download the app. When it's downloaded, open it, and you will be required to add your account information gotten from your broker. Here is how to do it. First, you add the broker name, your trading account number, then your password. You then click on Login, and you will be logged in if your details are correct. Now that you are in MetaTrader 5, here are the features of MT5 and how to use them. A downside of the app: when you click on quotes, it will show you all the currency pairs that you added to your trading list. Charts will show you a trading chart of the currencies you are trading. Trade will show you an overview of your balance and current trading activities. History will show you all your closed trading activities, withdrawal, deposits, profits and losses. Messages are the personalized messages from your broker about events, margin call and few maintenance and news. At the top of the app is a cross icon. It represents an adding tool. This helps you to add new currency pairs and other trading pairs to your trading quotes list. The pencil-like icon is a tool used to edit the trading list and also used for deleting currency pairs from the quote list. Inside the trading chart is a crossbar, used to calculate pips, viewing price levels, and to know the amount of bars that was formed during a particular range of time on the trading chart. You can also use it as a quick trend line and support or resistance line. The N-shaped tool is used for adding indicators on the chart. You can use it to also edit and delete indicators from the chart. All the indicators available on MetaTrader 5 can be found there. You start by clicking on the Add sign, then you select the indicators of your choice. The rectangular red and blue box is called the one-click trading icon. It is used to place fast market orders. Immediately you click the buy or sell button. You can stack as many trades as you want in seconds, after you must have placed the lot size of your desire. The circular red and blue box is a shortcut used for placing buy limits and sell limits. When you click on it, you can quickly pick the exact price spot which you want to place your trade limit on. If you click on any empty spot on the chart, you will see this rotary toolbox appear. It has different tools and a set of time frames you can easily navigate into when you want to view prices in a new time frame. If you click on this button, you will be able to divide the chart into two different charts, meaning you can be viewing to different time frames of a currency pair or two different currency pairs at the same time. Here is how to do it. When you click on the button, this button appears and you click on New Window. Then a new window will pop up like this. It first appears vertically, but if you want to change it to a horizontal view, which is much better, here is how to do it. Click on the chart, let the rotary tool appear, and now you click on the button once used to open the new chart.n. Then click on the horizontal button. That's it. You now have a horizontal double chart. If you click on this button, it will lead you to all your tools which you have drawn on the chart. You will be able to see them, edit them, and also delete them from your chart. The gear button will lead to the deeper settings on the chart. Let's see some of these settings and their real uses on the trading chart. The line type is used to change the chart view to either candlestick, line chart, or a bar chart. The OHLC helps you to know the open, close, high and low of a candlestick. When it is ticked, you will be able to see each detail of a candlestick by placing the crossbar on them, and you will be able to see the details of the current candlestick. If you tick on the Show Data window box, it will show you more additional candlestick information when you use the crossbar on it. If you click on Show Volumes, you will be able to add tick volumes to your trading chart, and you can also click on Show Real Volumes. So when you add the volume indicator to your chart, it will show the real trading volume of prices. If you tick Trade Position, it will show you your current trading position on your trading chart. When you tick on Trade Orders, it allows you to see your pending buy limits and sell limit orders on the chart. Ticking on Trade History reveals to you your former trading activities on the chart. SL and TP levels box shows your stop loss and take profit levels on the chart. If you tick on Show Period Separators, it will reveal to you additional vertical line on the chart, indicating the higher time frame borders. If you click on the Ask Price line and Last Price line, it will show you the wideness of the spreads on the chart. When you click on Trade Notification, it will show trading notifications on the trading chart. If you tick on One Click Panel at the bottom, it will show you the trading panel at the bottom of the chart, instead of it being at the top. If you click on Colors, you will be able to modify all the colors of the trading chart to your taste and desire. That's all you need to know about the MetaTrader 5 app for your phone. You can modify and change everything according to your desire and how you will like to take your strategic trades. You are the master of your trading life. To set up MetaTrader for your Windows PC, go to MetaTrader 5 official website www.metatrader5.com. Click on Download for Windows and the setup will be downloaded for you. This you can run and install on your PC, agreeing to all their terms and conditions. Now that you are on your PC, here are the important tools for your everyday trading. Just like in the mobile app, there are only a little differences between them. The software has a file icon, and this icon has different options. Amongst them you can log into your personal trading account. You can create a new trading chart. You can also open a new MetaTrader demo trading account. You will be able to save the picture of the information on the chart, and you can even print out your current chart setup. All these are available on the file icon. When you click the insert icon, it will lead you to different trading indicators and objects, which you can use for analysis. You can also create coding scripts for your analysis too. The chart icon will lead you to a list of tools like objects, where you can see the list of objects on your chart, where you can remove them in bulk. You can also change the chart view from candlesticks to bar charts and line charts. Is also a shortcut for choosing time frame and adding templates. You can also add grid view to the chart, add auto scroll, or chart shifts which shifts the chart for better views. Also used to add volumes directly, to also add and remove trade levels and trade history, zoom in and out of the chart. And lastly, properties. Here you can change the color of the chart to your preferred settings and desire. The Windows icon helps to navigate between different trading pairs and index easily. It also helps to arrange the trading tools into different Windows patterns. When you click on the Help icon, it will lead you to all the help, instructions, and guidance you need to use the MetaTrader 5 software. The Help icon comes with help for the different aspects of the trading software. The Chart-like icon is where you can add new trading pairs and indexes to your window. All the trading pairs you can trade under your broker will be available there. All the tools marked in red are your trading objects. And these red marked tools are your trading timeframe shortcut. When you add an object and you want to delete or edit them, right-click on your mouse and this box will appear. Here you can change properties of the object and also delete it. Here you can change the color, the thickness and other features you want about the object. You go down to Google Play Store or Apple Store to download the app. Then you sign up with your email address for a free account. It is not compulsory to sign in with your email address, but if you want your analysis to be saved after you've analyzed them, then you should register immediately. After that, you'll get a view like this one. When you click on Watch List, you will see all the trading pairs, commodities, indexes, crypto and stocks you have added to your watch list. There, you can also search for other tradable currencies. When you click on this pencil-like tool, it will lead you to all the objects available to make your great analysis on TradingView. You can select any tool of your choice on it, including emojis and stickers. When you click on this icon, you will be able to add the currency to your favorites and will be able to also remove it from your favorites. I know people who do this a lot when they had lost multiple times. They usually blame the currency. When you click on the FX tool, you will be able to add indicators to your chart. You can search and add any indicator there. I have just added Bollinger Bands indicator to my trading chart. When you click on the Time tool, you will be able to add price alerts in order to keep you updated on price changes when you may be busy doing other things or checking out other currencies. There are many price alerts types you can choose from. When you click on the plus tool, you will be able to compare another currency with the one on your chart. Many traders use this as indicators because they believe some currencies actually trade opposite each other. When you are done analyzing, you can remove them from the same place you added the from. Just click on it and it will be removed from the chart. When you click on this box, you will be able to add an indicator template. An indicator template is a combination of two or more indicators for a particular strategy. You can add any template of your choice from the list, and you can also create your own template by combining indicators together. When you are done analyzing, you can remove them. The Share tool helps you to save a picture of the chart to your phone. Share the image to social media platforms or share link to the chart image. The candlestick tool helps you to choose other candlesticks patterns, such as the hollow candles, Heiken Ishii, and the rest. This is Heiken Ishii candlestick. And this is the hollow candles. You can choose any type of your choice. The three dots include other tools and setting, such as the chart settings, security details, technicals, object tree, and even alert management. When you click on the Explore button, it will show you a community of fellow traders sharing their trading analysis and ideas. You can engage with them and grow your understanding, but don't depend on them, because too many advices will lead you to confusion on your own analysis. Technical analysis is a method used by traders and investors to evaluate and forecast future price movements of financial assets, such as stocks, currencies, commodities, and indices, based on historical price data and trading volume. It involves the study of charts, patterns, and technical indicators to identify trends, support and resistance levels, and potential entry and exit points for trades. If technical analysis is well mastered, you will become a trader who can see the future of price assets. Technical analysts primarily use price charts, such as line charts, bar charts, and candlestick charts, to visualize historical price data over different time frames, such as minutes, hours, days, or weeks. Price charts display the opening, closing, high, and low prices for a specific period, allowing traders to identify patterns and trends in price movements. Technical analysts analyze price charts to identify trends, which represent the general direction of price movements over time. Trends can be classified as uptrends, rising prices, downtrends, falling prices, or sideways trends, horizontal price movements. Trend analysis helps traders identify potential entry points to buy or sell assets in the direction of the current trend. Following the trend is the best thing you learn in technical analysis, and everything you learn in technical must be directed to studying the trend and following it. There are many ways and strategies to analyze the trend movement in technical analysis. Out of the many of them includes support and resistance, trend lines, supply and demand, indicators, and many more. Let's take a look at some of them. Support and resistance levels are price levels, where buying and selling pressure is expected to be significant. Support levels act as floors that prevent prices from falling further, while resistance levels act as ceilings that prevent prices from rising higher. We also use support and resistance levels to identify potential reversal points and to set stop loss and take profit levels for trades. The support and resistance levels forms as a result of strong trading activity at a particular area on a price chart. And as traders, we believe that the market repeats history, and we leverage on that belief to discover the support and resistance lines. It forms as a result of heavy price activities by traders at that areas, and it is validated by two or more price movements on that particular area on the chart. It takes two evident touches for a line to be called a support or a resistance level. Sometimes they can be a change of character, where a support can become resistance after price has traded below it, and also a resistance line can become support after the market has traded much above it. If a trader practices well on support and resistance strategy, he or she can be able to determine significant price movement on the chart, and a lot of profits will be made at ease. Trend lines are one of the fundamental tools used in technical analysis to identify and visualize trends in price movements. They are straight lines drawn on price charts to connect successive highs or lows in a series of price data. Trend lines help a trader to identify the direction and strength of a trend and can be used to anticipate potential support and resistance levels, trend reversals, and continuation patterns. An uptrend line is drawn by connecting successive higher lows in a price series. It indicates that the market is moving upward with buyers in control and suggests potential buying opportunities at support levels. A downtrend line is drawn by connecting successive lower highs in a price series. It indicates that the market is moving downward with sellers in control and suggests potential selling opportunities at resistance levels. To be considered valid, a trend line should connect at least to significant swing highs or lows, preferably 3 or more. The more data points that confirm a trend line, the more reliable it is. Once a trend line is drawn, traders look for confirmation that price respects the trend line by bouncing off it or breaking through it with conviction. A bounce off a trend line confirms its validity, while a breakout signals a potential trend reversal or continuation. The slope and angle of a trend line provides valuable information about the strength and momentum of the trend. Steeper trend lines indicate stronger trends, while shallower trend lines suggest weaker trends. Trend lines with very steep angles may be unsustainable and prone to sharp corrections, while trend lines with moderate angles may offer more stable and sustainable trends. In an uptrend line acts as a dynamic support level, providing potential buying opportunities when price retraces to the trend line. Meanwhile, in a downtrend line acts as a dynamic resistance level, providing potential selling opportunities when price rallies to the trend line. Breakouts occur when price decisively penetrates and closes above or below a trend line, signaling a potential trend reversal or continuation. Pullbacks occur when price retraces back to the trend line after a breakout, providing opportunities to enter trades in the direction of the trend at better prices. Trend line is the most profitable trading tool in trading, that if traded properly, it's almost like making profits every day, at will. Supply and demand principles apply similarly to other financial markets, but with some unique characteristics specific to the Forex market. Here's how supply and demand concepts manifest in Forex trading. In the Forex market, supply and demand refer to the availability and desire of participants to buy or sell currencies. Each currency pair represents the exchange rate between two currencies, where one currency is bought, demand, and the other is sold, supply. The supply of a currency is determined by factors such as central bank policies, economic indicators, trade balances, and geopolitical events affecting the issuing country's economy. The demand for a currency is influenced by factors such as interest rates, economic growth prospects, political stability, and investor sentiment toward the issuing country's currency. The exchange rate of a currency pair is determined by the interaction of supply and demand in the Forex market. When demand for a currency exceeds its supply, its value appreciates relative to other currencies. Conversely, when supply exceeds demand, its value depreciates. Price movements in the Forex market reflect changes in supply and demand dynamics. Trends, reversals, and consolidations in currency pairs are driven by shifts in supply and demand forces. Technical analysis tools, such as support and resistance levels, trend lines, and chart patterns are often used by Forex traders to identify supply and demand zones and anticipate potential price movements. Chart patterns are recognizable formations that occur on price charts and provide valuable insights into potential future price movements. As traders use chart patterns as part of technical analysis to identify trends, trend reversals, and continuation patterns, allowing them to make informed trading decisions. Here are some common chart patterns used in Forex trading. Double top and double bottom. A double top is a pattern that occurs when the price forms to peaks at approximately the level separated by a trough. It signals a potential trend reversal from bullish to bearish when the price breaks below the trough support level. This is a very bearish reversal pattern. It is very effective on price movement. The double bottom pattern is the inverse of the double top pattern. This formation occurs when Thesan price forms to troughs at approximately the same level, separated by a peak. It signals a potential trend reversal from bearish to bullish when the price breaks above the peak's resistance level. This is a great bullish reversal pattern, and it is the most seen pattern on the chart. The head and shoulders pattern. This pattern consists of a peak the head. Between two lower peaks are the shoulders. It signals a potential trend reversal from bullish to bearish when the price breaks below the neckline, which is connecting the lows of the two shoulders. The inverse head and shoulders is the inverse of the head and shoulders pattern. This formation consists of a trough, head, between two higher troughs, shoulders. It signals a potential trend reversal from bearish to bullish when the price breaks above the neckline. Triangles. Triangles are consolidation patterns, mainly characterized by converging trend lines. There are three main types of triangles. 1. Symmetrical triangle. Symmetrical triangles form when the price oscillates between a series of lower highs and higher lows, creating two converging trend lines that meet at a roughly equal angle. As the pattern progresses, the range between the highs and lows narrows, giving the triangle its symmetrical shape. The symmetrical triangle pattern is typically a continuation pattern, meaning it often leads to a continuation of the prevailing trend. However, it can also act as a reversal pattern if it forms at the end of a prolonged trend. Many traders often wait for a breakout above or below the symmetrical triangle's trend lines to confirm the pattern's direction. A breakout above the upper trend line suggests a bullish momentum and a potential continuation of an uptrend, while a breakout below the lower trend line indicates bearish sentiment and a potential continuation of a downtrend. 2. Ascending triangles. Ascending triangles form when the price consolidates within a narrowing range, with the upper boundary acting as a horizontal resistance level, and the lower boundary as an ascending support trend line. Ascending triangles are continuation patterns, indicating a potential continuation of the prevailing uptrend. Traders often wait for a breakout above the flat upper trend line to confirm the ascending triangle pattern's direction. A breakout above the upper trend line suggests bullish momentum and a potential continuation of the uptrend. 3. Descending triangles. Descending triangles form when the price experiences lower highs, indicating downward pressure, while the lows remain relatively flat, forming a horizontal support level. The descending upper trend line connects the lower highs, while the flat lower trend line acts as support, creating a triangle pattern. Descending triangles are typically continuation patterns, indicating a potential continuation of the current downtrend. Traders wait for a breakout below the flat lower trend line to confirm the descending triangle pattern's direction. A breakout below the lower trend line suggests bearish momentum and a potential continuation of the downtrend. Flags and pennants are continuation chart patterns that typically occur after a strong price movement in the market. They are characterized by a period of consolidation, followed by a continuation of the previous trend. Flags form when the price experiences a sharp and significant move in one direction, known as the flagpole. This is followed by a period of consolidation, where the price trades within a narrowing range, forming a flag shape. We trade the flag pattern by waiting for a breakout above or below the flag pattern's trend lines to confirm the continuation pattern's direction. A breakout above the upper trend line of a bull flag suggests bullish momentum and a potential continuation of the uptrend, while a breakout below the lower trend line of a bear flag indicates bearish sentiment and a potential continuation of the downtrend. Pennants form when the price experiences a sharp and significant move in one direction, known as the flagpole. This is followed by a period of consolidation, where the price trades within a narrowing range, forming a pennant shape. The pennant is characterized by two converging trend lines, similar to a symmetrical triangle. As traders, we often wait for a breakout above or below the pennant pattern's trend lines to confirm the continuation pattern's direction. A breakout above the upper trend line of a bullish pennant suggests bullish momentum and a potential continuation of the uptrend, while a breakout below the lower trend line of a bearish pennant indicates bearish sentiment and a potential continuation of the downtrend. Cup and handle. The cup and handle pattern consists of two main parts, the cup and the handle. The cup forms as the price initially rises to form a rounded bottom, resembling the shape of a cup or bowl. This phase represents a period of accumulation where buyers gradually gain control over sellers. After the cup formation, the price may experience a slight pullback or consolidation, forming the handle, which is characterized by a smaller, downward-sloping price movement. The handle typically forms as a shallow retracement, often resembling a flag or pennant pattern. The cup and handle pattern is considered a continuation pattern, indicating a potential continuation of the previous uptrend. Traders usually wait for a breakout above the resistance level formed by the high point of the cup to confirm the continuation pattern's direction. Chart patterns are very reliable tools for technical analysis. More in-depth understanding about them will make many traders profitable. A candlestick is a graphical representation of price movements for a specific period of time, commonly used in technical analysis of financial markets, including Forex trading. Each candlestick provides information about the opening, closing, high, and low prices for the given time period, typically ranging from minutes to hours, days, weeks, or months. Candlestick charting originated in Japan in the 17th century, during the early days of the Japanese rice markets. The method was developed by Japanese rice traders to analyze price movements and predict future market trends. The earliest known reference to candlestick charting techniques can be found in a book called Sakata's 5 Methods, Sokoto Goho, written by Honma Munihisa, a Japanese rice trader, in the early 18th century. Candlestick charting remained largely unknown to the Western world until the late 20th century. In the 1980s, Steve Nissen, an American trader and technical analyst, introduced candlestick charting to Western traders through his book, Japanese Candlestick Charting Techniques, published in 1991. Nissen studied Japanese candlestick patterns during a trip to Japan and recognized their effectiveness in analyzing financial markets. He translated and popularized Japanese candlestick techniques for Western traders, contributing to the widespread adoption of candlestick charting in the global financial community. Candlestick charting gained popularity among traders and investors due to its simplicity, visual clarity, and effectiveness in identifying market trends and patterns. Traders appreciated the ability of candlestick charts to provide insights into market sentiment and potential price reversals. Candlestick patterns became widely recognized and studied by traders worldwide. Candlestick charting became an integral part of technical analysis, alongside other charting methods, such as bar charts and line charts. Traders began using candlestick patterns in conjunction with technical indicators, support and resistance levels, and other analysis techniques to make well-informed trading decisions. Candlestick patterns are now widely used in various financial markets, including stocks, Forex, commodities, and cryptocurrencies. Here's how a trading candlestick is structured and what each part represents. Body. The body of the candlestick represents the price range between the opening and closing prices during the specified time period. If the closing price is higher than the opening price, the candlestick is typically filled or colored white or green, indicating a bullish movement. If the closing price is lower than the opening price, the candlestick is usually hollow or colored black or red, indicating a bearish movement. Wicks. The wicks, also known as shadows or tails, extend from the top and bottom of the candlestick's body and represent the highest and lowest prices reached during the time period. The upper wick shows the highest price reached during the period, while the lower wick shows the lowest price reached. The length of the wicks provides insights into price volatility and the trading range for the period. Candlestick patterns are formations of one or more candlesticks on a price chart that provide valuable insights into market sentiment and potential future price movements. These patterns are used by traders in technical analysis to make informed trading decisions. Here are some common candlestick patterns. 1. Doji. A doji candlestick forms when the open and close prices of an asset are nearly the same, resulting in a candlestick with a very small body. Doji candlesticks are considered to be significant reversal or indecision patterns, depending on their context within the price action. They indicate a balance between buyers and sellers, where neither group has been able to establish control over the direction of the market. As a result, doji candlesticks often occur at key support or resistance levels, signaling potential trend reversals or trend continuation. A doji candlestick depends on its position within the price action and its relationship with preceding and subsequent candlesticks. In an uptrend, a doji candlestick signals weakening bullish momentum or a potential trend reversal if it occurs at or near resistance levels. Conversely, in a downtrend, a doji candlestick may indicate weakening bearish momentum or a potential trend reversal if it occurs at or near support levels. A hammer candlestick forms when the open, high, and close prices are relatively close together, typically near the high of the session, while the low price is significantly lower, resulting in a long lower shadow or wick. The small body of the candlestick is usually at or near the top of the candlestick's range, giving it the appearance of a hammer. The hammer candlestick pattern is considered to be a bullish reversal pattern when it occurs during a downtrend. It suggests that despite initial selling pressure, pushing prices lower during the session, buyers managed to regain control by the close, leading to a potential reversal in the downtrend. The long lower wick indicates that prices were pushed significantly lower, but ultimately rejected at those levels, signaling bullish momentum. When a hammer candlestick occurs during a downtrend, traders interpret it as a potential signal that selling pressure is fading and that buyers may be stepping in to drive prices higher. However, it's important to consider the context in which the hammer appears, such as its location within the overall price action and its relationship with key support and resistance levels. 3. Shooting star. A shooting star candlestick forms when the open, high, and close prices are relatively close together, typically near the high of the session, while the low price is significantly lower, resulting in a long upper shadow or wick. The small body of the candlestick is usually at or near the bottom of the candlestick's range, giving it the appearance of a star. The shooting star candlestick pattern is considered to be a bearish reversal pattern when it occurs during an uptrend. It suggests that, despite initial buying pressure pushing prices higher during the session, sellers managed to regain control by the close, leading to a potential reversal in the uptrend. The long upper wick indicates that prices were pushed significantly higher, but ultimately rejected at those levels, signaling bearish momentum. Confirmation may come in the form of a subsequent candlestick closing lower, increased volume, or the presence of other technical signals supporting a bearish reversal. When a shooting star candlestick occurs during an uptrend, traders interpret it as a potential signal that buying pressure is fading and that sellers have stepped in to drive prices lower. 4. The engulfing candlestick. The engulfing candlestick pattern consists of two candles. The first candle is smaller and typically represents a short-term trend, while the second candle is larger and completely engulfs or covers the body of the first candle. The second candle opens below the close of the first candle for a bullish engulfing pattern, or opens above the close of the first candle for a bearish engulfing pattern, and closes beyond the high or low of the first candle. A bullish engulfing pattern occurs at the end of a downtrend and signals a potential reversal to the upside. The first candle is bearish, indicating selling pressure, while the second candle is bullish and completely engulfs the body of the first candle. It suggests that buyers have overwhelmed sellers, leading to a shift in sentiment from bearish to bullish. A bearish engulfing pattern occurs at the end of an uptrend and signals a potential reversal to the downside. The first candle is bullish, indicating buying pressure, while the second candle is bearish and completely engulfs the body of the first candle. It signifies that sellers have overwhelmed buyers, leading to a shift in sentiment from bullish to bearish. Engulfing candlestick patterns are considered strong reversal signals because they represent a significant shift in market sentiment from one candle to the next. The larger size and complete engulfing of the previous candle indicate a decisive move by buyers or sellers, potentially leading to a continuation of the new trend. 5. The evening and morning star. The evening star pattern consists of three candles. The first candle is a large bullish candlestick, representing a strong uptrend. The second candle is a small-bodied candlestick that can be bullish or bearish. It often has a small body and signal indecision in the market. The third candle is a large bearish candlestick that opens below the close of the second candle and closes well into the body of the first candle, preferably below the midpoint of the first candle. The evening star pattern is considered a strong bearish reversal signal because it suggests that the buying pressure from the previous uptrend has weakened and sellers are gaining control. The first bullish candle indicates strong buying momentum, followed by a period of indecision or consolidation, represented by the small-bodied second candle. Finally, the third bearish candle confirms the reversal by closing lower and erasing most of the gains from the first candle. Morning star. The morning star pattern consists of three candles. The first candle is a large bearish candlestick, representing a strong downtrend. The second candle is a small-bodied candlestick that can be bullish or bearish. It often has a small body and may signal indecision in the market. The third candle is a large bullish candlestick that opens above the close of the second candle and closes well into the body of the first candle, preferably above the midpoint of the first candle. The morning star pattern is considered a strong bullish reversal signal because it suggests that the selling pressure from the previous downtrend has weakened and buyers may be gaining control. The first bearish candle indicates strong selling momentum, followed by a period of indecision or consolidation, represented by the small-bodied second candle. Finally, the third bullish candle confirms the reversal by closing higher and erasing most of the losses from the first candle. The evening star and the morning star candlestick pattern is widely used by traders because it provides valuable insights into potential trend reversals. The tweezer pattern occurs when two consecutive candlesticks have matching highs or lows, indicating a period of indecision or equilibrium between buyers and sellers. There are two variations of the tweezer pattern. 1. Tweezer top, formed when two candlesticks have identical highs, with the first candle being bullish and the second candle being bearish. It suggests a potential reversal from bullish to bearish. The tweezer bottom is formed when two candlesticks have identical lows, with the first candle being bearish and the second candle being bullish. It signals a reversal from bearish to bullish price movement. When a tweezer pattern occurs, traders interpret it based on its location within the overall price action and its relationship with key support and resistance levels. Overall, a tweezer top at a resistance level indicates a strong reversal to the downside, while a tweezer bottom at a support level signals a strong reversal to the upside. Trading time frames refer to the different intervals or periods of time used to analyze price movements and make trading decisions in financial markets. Each time frame represents a specific duration, such as minutes, hours, days, weeks, or months, and provides traders with different perspectives on market trends and price action. Here are some common trading time frames. Intraday time frames. Intraday time frames include minute charts. These charts display price movements within each minute, providing detailed intraday analysis for day traders who execute trades within short time frames. Hourly charts. Hourly charts show price movements over each hour, offering a broader perspective for intraday traders while still focusing on shorter-term trends and patterns. Short-term time frames. Short-term time frames include the 4-hour chart. The 4-hour chart provides a more comprehensive view of price action over shorter periods, often used by swing traders and short-term traders to identify trends and great entry and exit points. Daily charts. Daily charts display price movements over each trading day, allowing traders to analyze longer-term trends and make trading decisions based on daily price action. Medium-term time frames. Medium-term time frames includes weekly charts. Weekly charts show price movements over each trading week, providing a broader perspective for medium-term traders and investors to identify major trends and trading opportunities. Monthly charts. Monthly charts display price movements over each trading month, offering an even longer-term view for investors and position traders to analyze market trends and make strategic investment decisions. Long-term time frames. Long-term time frames include quarterly charts. Quarterly charts show price movements over each calendar quarter, providing an even broader perspective for long-term investors and institutions to assess market trends and portfolio performance. Yearly charts. Yearly charts display price movements over each calendar year, offering the longest-term view for investors to evaluate historical performance and make strategic asset allocation decisions. Forex traders come in various types, each with different trading styles, objectives, and timeframes. Here are some common types of Forex traders. 1. Day traders. Day traders are traders who open and close positions within the same trading day, aiming to profit from short-term price movements. They often use intraday charts and technical analysis to identify trading opportunities and execute multiple trades throughout the day. Day traders typically do not hold positions overnight, as they seek to avoid overnight market risks. 2. Swing traders. Swing traders hold positions for several days to weeks, aiming to capture intermediate-term price movements within the context of a larger trend. They use a combination of technical analysis and fundamental analysis to identify potential entry and exit points, focusing on medium-term trends and price patterns. Swing traders are less concerned with intraday price fluctuations and may hold positions overnight or over weekends. 3. Position traders. Position traders hold positions for weeks, 2 months, or even longer, aiming to capture long-term trends and capitalize on fundamental factors driving currency movements. They conduct in-depth analysis of macroeconomic trends, geopolitical events, and central bank policies to form longer-term trading strategies. Position traders typically have a more relaxed approach to trading and are willing to withstand short-term price fluctuations in pursuit of larger profit targets. 4. Scalpers. Scalpers are traders who aim to profit from small price movements by executing a large number of trades within a short period, often seconds to minutes. They rely heavily on technical analysis and fast execution to exploit short-term market inefficiencies and fluctuations. Scalping requires quick decision-making, discipline, and the ability to react swiftly to changing market conditions. 5. Algorithmic traders. Algorithmic traders, also known as algo traders, use automated trading systems, also known as trading algorithms or bots, to execute trades based on predefined criteria and rules. They develop or purchase trading algorithms that analyze market data, identify trading signals, and execute trades automatically without human intervention. Algo traders utilize many strategies, including trend following, mean reversion, and statistical arbitrage, to profit from Forex markets. Which of these traders are you right now? Or which of them do you think you will become? As time goes on, you will find out within yourself the one that actually suits your desired lifestyle. Market participants are those individuals or institution that move price in the market. They are various types of participants engaging in buying, selling, and exchanging currencies, contributing to market liquidity and price fluctuations. Here are the main market participants in the Forex market. 1. Commercial banks. Commercial banks are among the largest participants in the Forex market, facilitating currency transactions for corporate clients, institutional investors, and retail customers. They engage in Forex trading to meet the needs of their clients, manage currency exposure, and profit from currency trading activities. 2. Central banks. Central banks play a crucial role in the Forex market through monetary policy decisions, intervention in currency markets, and foreign exchange reserve management. They conduct currency operations to stabilize exchange rates, influence money supply and inflation, and maintain economic stability. 3. Investment banks. Investment banks engage in Forex trading on behalf of clients, including corporations, hedge funds, pension funds, and other financial institutions. They provide liquidity, market-making services, and advisory services in the Forex market, executing trades and facilitating currency transactions. 4. Hedge funds and asset managers. Hedge funds and asset managers trade currencies to hedge against currency risk, diversify portfolios, and seek alpha, excess returns. They employ various strategies, including trend following, carry trading, and macroeconomic analysis, to profit from currency movements. 5. Retail traders. Retail traders are individual traders who participate in the Forex market through online trading platforms offered by brokers. They speculate on currency movements, aiming to profit from short-term price fluctuations or longer-term trends. Retail traders account for a significant portion of Forex trading volume, particularly in major currency pairs. 6. Corporations and multinational companies. Corporations and multinational companies engage in Forex transactions to manage currency exposure resulting from international trade, investments, and operations. They use Forex hedging strategies to mitigate currency risk and protect profit margins from adverse exchange rate movements. 7. Governments and sovereign wealth funds. Governments and sovereign wealth funds participate in the Forex market to manage foreign exchange reserves, finance international trade, and support economic objectives. They may intervene in currency markets to influence exchange rates, maintain competitiveness, or address balance of payments issues. 8. Retail brokers. Retail brokers are intermediaries that provide access to the Forex market for retail traders, offering trading platforms, leverage, and access to liquidity providers. They earn revenue through spreads, commissions, and other fees charged on client trades. Bulls and bears are terms used to describe the behavior of market participants towards asset prices. These terms originated from the characteristics of these animals. A bull attacks by thrusting its horns upward, symbolizing rising prices, while a bear attacks by swiping its paws downward, symbolizing falling prices. Here's what each term represents. Bulls. Bulls are investors or traders who are optimistic about the future direction of asset prices. They believe that prices will rise or are currently rising, and they actively buy or hold assets with the expectation of profiting from upward price movements. Bull markets are periods characterized by rising asset prices, increasing investor confidence, and a general sense of optimism in the market. Bears. Bears are investors or traders who are pessimistic about the future direction of asset prices. They believe that prices will fall or are currently falling, and they may sell assets short or avoid buying assets in anticipation of further declines. Bear markets are periods characterized by declining asset prices, decreasing investor confidence, and a general sense of pessimism in the market. Indicators, in the context of financial markets, are tools used by analysts to interpret market data, identify trends, and make trading decisions. These indicators are typically derived from price and volume data and provide insights into market dynamics and potential future price movements. Let's look at some common types of indicators used in trading. 1. Trend indicators. Trend indicators help traders identify the direction and strength of market trends. They include moving averages, trend lines, and trend-following indicators, such as the average directional index, a DX, and moving average convergence divergence, MACD. 2. Momentum indicators. Momentum indicators measure the speed and magnitude of price movements, helping traders identify overbought or oversold conditions and potential trend reversals. Examples include the Relative Strength Index, RSI, stochastic oscillator, and momentum oscillator. 3. Volatility indicators. Volatility indicators quantify the degree of price fluctuations or volatility in the market. They include measures such as the average true range ATR, Bollinger Bands, and volatility index VIX. 4. Volume indicators. Volume indicators analyze trading volume, representing the number of shares or contracts traded during a specified period. Examples include on-balance volume OBV, check-in money flow, and volume-weighted average price V, WAP. 5. Support and resistance indicators. These indicators identify key levels of support and resistance on price charts, which represent areas where buying or selling pressure may increase. Examples include pivot points, Fibonacci retracement levels, and horizontal support and resistance lines. 6. Sentiment indicators. Sentiment indicators gauge market sentiment or investor sentiment, providing insights into crowd psychology and potential market reversals. Examples include the put and call ratio, commitments of traders reports, COT, and fear and greed index. It's very important to note that the Forex market is not open continuously throughout the entire week due to different trading sessions across major financial centers worldwide. Here are the main Forex market hours. Sydney session opens 10 p.m. GMT, Sunday, and closes 7 a.m. GMT, Monday. Tokyo session opens 12 a.m. GMT, closes 9 a.m. GMT. London session opens 8 a.m. GMT, closes 5 p.m. GMT. New York session opens 1 p.m. GMT, closes 10 p.m. GMT. These are the primary Forex trading sessions, and they overlap during certain periods, providing increased liquidity and trading opportunities. The most active trading sessions typically occur during the overlap between two or more sessions. Here are the major overlaps. London, New York, overlap 1 p.m. GMT to 5 p.m. GMT. Tokyo, London overlap 8 a.m. GMT to 9 a.m. GMT. Tokyo, New York overlap 12 a.m. GMT to 5 a.m. GMT. Here are some common mistakes that traders should avoid while trading. 1. Lack of proper education. Not having a solid understanding of the Forex market, trading strategies, risk management, and trading psychology can lead to costly mistakes. It's very wise to invest time in learning and gaining experience before actively trading. 2. Over-leveraging. Using excessive leverage can amplify both profits and losses, leading to significant account drawdowns or even wipeouts. Learn how to use leverages suitable for your account size and only trade with amounts you can afford to lose. 3. Ignoring risk management. Failing to implement proper risk management techniques, such as setting stop-loss orders, position sizing, and diversification, can result in substantial losses. Always prioritize capital preservation and protect your trading account from excessive risk. 4. Emotional trading. Allowing emotions such as fear, greed, and impatience to dictate trading decisions can lead to irrational behavior and poor trading outcomes. Maintain discipline, stick to your trading plan, and avoid making impulsive decisions based on emotions. 5. Chasing the market. Trying to chase price movements or entering trades based on FOMO, fear of missing out, can lead to entering positions at unfavorable prices and suffering losses. Wait for suitable setups and avoid FOMO-driven trading. 6. Lack of patience. Trading requires patience and discipline. Rushing into trades without waiting for proper confirmations or exiting trades prematurely can lead to missed opportunities or unnecessary losses. Be patient and wait for high-probability trading setups. 7. Overtrading. Trading too frequently or trading multiple currency pairs simultaneously can increase transaction costs, lead to decision fatigue, and dilute focus. Focus on quality over quantity, and only trade when the conditions are favorable. 8. Not keeping records. Failing to maintain a trading journal to track trades, analyze performance, and identify areas for improvement can hinder progress as a trader. Keep detailed records of your trades, including entry and exit points, reasons for trade decisions, and trade outcomes. 9. Ignoring market conditions. Not considering broader market conditions, such as economic indicators, geopolitical events, and central bank policies, can lead to trading against the trend or entering trades in volatile market environments. Stay informed about market developments and adapt your trading approach accordingly. 10. Lack of adaptability. Markets are dynamic and constantly evolving. Failing to adapt to a changing market conditions or rigidly sticking to a single trading strategy can limit trading success. Be flexible and willing to adjust your approach based on market dynamics and feedbacks from your trading results. If you are ever having issues with your trading life, check back this video all the time because your problem lies among one of these mistakes. Once you have mastered them, you will make eminent profits in your trading career. Brokers are intermediaries or financial institutions that facilitate trading activities between buyers and sellers in financial markets, including the Forex market. They provide access to trading platforms, execution services, market research, and other resources for traders to buy, sell, or exchange currencies and other financial instruments. Here are the types of brokers. 1. Retail brokers. Retail brokers cater to individual traders and investors, offering online trading platforms and services to access the Forex market. They typically provide retail clients with leverage, access to multiple currency pairs, and various trading tools. Examples include Oanda, IG Group, TD Ameritrade, and Forex.com. 2. Institutional brokers. Institutional brokers serve institutional clients, such as banks, hedge funds, asset managers, and corporations, facilitating large-scale currency transactions, Forex hedging, and portfolio management services. Examples include Goldman Sachs, JP Morgan Chase, Citigroup, and Deutsche Bank. 3. Market makers. Market makers are brokers that provide liquidity to the market by quoting both bid and ask prices for currency pairs. They earn revenue from the spread, which is the difference between the bid and ask prices. Examples include FXCM, Avatrade, and XM. Electronic communication network brokers. ECN brokers operate electronic trading networks that connect traders directly to liquidity providers, such as banks, financial institutions, and other traders. They offer direct market access, DMA, and typically charge commissions instead of spreads. Examples include IC Markets, Pepperstone, and LAMX Exchange. 7. Prime brokers. Prime brokers provide services to institutional clients, including access to multiple liquidity sources, trade execution, clearing, and custody services. They cater to hedge funds, asset managers, and other large financial institutions. Examples include Morgan Stanley and Barclays. 8. White label brokers. White label brokers are companies that offer trading platforms and services under their own brand name, but rely on the infrastructure and technology of a larger broker or financial institution. They often target niche markets or specific regions. Examples include smaller Forex brokers that use platforms provided by larger brokerage firms. Brokers handle clients' funds in several ways to facilitate trading activities and ensure the security of the funds. Here's what brokers typically do with clients' money. Segregated accounts. Regulated brokers are required to keep clients' funds separate from their own operational funds. This segregation of accounts ensures that clients' funds are protected in the event of the broker's insolvency. Clients' funds are held in segregated bank accounts, distinct from the broker's operating accounts. Margin requirements. When traders open positions using leverage, brokers will require them to deposit a certain amount of capital as margin. This margin serves as collateral for the leveraged trades and helps mitigate the risk of default. Brokers may hold these margin funds in segregated accounts until the positions are closed or margin requirements are adjusted. Trading capital. Clients' funds are used to execute trades in the financial markets. When clients place orders through their trading accounts, brokers use their funds to purchase or sell financial instruments on their behalf. The profits or losses from these trades are reflected in clients' trading accounts. Withdrawals and deposits. Brokers facilitate withdrawals and deposits for clients, allowing them to transfer funds to and from their trading accounts. When clients withdraw funds, brokers process the withdrawal requests and transfer the requested amounts to clients' designated bank accounts. Similarly, when clients deposit funds, brokers credit the deposited amounts to clients' trading accounts. Interest and fees. Brokers generate revenue by earning interest on clients' idle funds held in trading accounts, or by charging fees for trading services, such as spreads, commissions, and overnight financing charges. Clients may also earn interest on their unused margin funds, depending on the broker's policies. Risk management. Brokers use clients' funds to manage various risks associated with trading, including market risk, credit risk, and operational risk. They may implement risk management measures, such as setting leverage limits, margin requirements, and trading restrictions to protect both clients and the broker's capital. When choosing a broker, it's very important to consider some factors to ensure you get a positive trading experience and the security of your funds. Here are 5 criteria for choosing a good broker. 1. Regulation and compliance. Ensure that the broker is regulated by a reputable financial authority and a well-established jurisdiction. Regulatory bodies, such as the Financial Conduct Authority (FCA) in the UK, the Securities and Exchange Commission (SEC) in the US, and the Australian Securities and Investments Commission (SIC), impose strict regulatory standards on brokers to protect clients' funds and ensure fair trading practices. 2. Security of funds. Look for brokers that segregate clients' funds from their own operational funds. Segregated accounts help protect clients' funds in the event of the broker's insolvency. Additionally, consider brokers that offer investor compensation schemes or insurance coverage to provide an extra layer of protection for clients' funds. 3. Trading conditions. Evaluate the broker's trading conditions, including spreads, commissions, leverage, and execution quality. Choose a broker with competitive pricing and transparent fee structures to minimize your trading costs. Make sure that the broker offers tighter spreads, fast and reliable order execution, and a wide range of trading instruments to meet your trading needs. 4. Trading platforms and tools. Assess the broker's trading platforms and tools to make sure they meet requirements for functionality, usability, and compatibility. Look for brokers that works on user-friendly trading platforms, such as MetaTrader 4 or 5, as well as their mobile trading apps for quick trading, such with great technical analysis indicators, market news, and educational materials. 5. Customer service and support. Check the quality of customer service and support offered by the broker. Choose a broker that provides responsive and knowledgeable customer support through various channels like the live chat, email, phone support, and other online help resources. Make sure you look out for all these 5 criteria to make sure you have a comfortable trading career, as a broker is one of the major influence on a trading account. Forex news refers to information and updates about events, developments, and factors which influence the foreign exchange market. Forex news plays a big role in influencing currency prices. Wise traders and investors closely monitor Forex news to make informed trading decisions and capitalize on market opportunities. Here are some key aspects of Forex news that influence the market. 1. Economic indicators. Forex news often includes releases of economic indicators and data from major economies around the world. These indicators, such as GDP growth, employment figures, inflation rates, and central bank interest rate decisions, provide insights into the health and performance of economies, influencing currency valuations. 2. Central bank announcements. Central bank shapes currency movements through monetary policy decisions, interest rate changes, and quantitative easing programs. The Forex news covers central bank meetings, statements, and speeches by central bank officials, providing clues about future policy directions and their potential impact on currencies. 3. Geopolitical events. Geopolitical developments, such as political instability, conflicts, trade tensions, and diplomatic relations between countries, can affect currency markets by creating uncertainty and risk aversion. Forex news in general reflects investor psychology, influencing currency prices through shifts in risk appetite towards specific currencies and overall market trends. News headlines, market commentary, and analyst reports contribute to shaping and influencing trading decisions. To backtest a trading strategy effectively, follow these steps. 1. Define your trading strategy. Clearly outline the rules and criteria of your trading strategy, including entry signals, exit signals, position sizing, risk management rules, and any other relevant parameters. 2. Select historical data. Choose a suitable dataset of historical market data for the assets you intend to trade. This dataset should cover the time period over which you want to backtest your strategy and include relevant price data for the selected time frames. 3. Choose a backtesting platform or software. Select a backtesting platform or software that meets your needs and supports the features and functionalities required for your strategy. Popular backtesting platforms include MetaTrader, TradingView, NinjaTrader, and AmiBroker. 4. Run the backtest Execute the backtest using the historical market data and your defined trading strategy. With the backtesting software or the trading platform, you will be able to simulate trades according to the rules of your strategy, generating simulated buy and sell signals, entry and exit points, position sizes, and trade outcomes. 5. Analyze results. Review and analyze the backtest results to evaluate the performance of your trading strategy. Assess the key performance metrics, such as the profitability, risk-to-reward ratio, drawdown analysis, win rate, and other relevant statistics. Forward test your strategy by deploying it in a live or simulated trading environment, like a demo account, to understand its performance in real-time market conditions, and so doing it also helps to increase your confidence to take the trades on real accounts. Follow all these processes to exercise your trading strategy and build a stronger trading career. Here are some key trading psychology ideas that can help traders improve their mental and emotional approach to trading. 1. Self-awareness. Understand your own strengths, weaknesses, and psychological tendencies as a trader. Recognize how your emotions, such as fear, greed, and overconfidence influences your decision-making process. 2. Develop a trading plan. Create a well-defined trading plan with clear entry and exit criteria, risk management rules, and trading objectives. Having a structured plan helps reduce uncertainty and emotional reactions during trading. 3. Risk management. Prioritize risk management and capital preservation. Use stop-loss orders, position sizing techniques, and proper lot size to manage risk effectively and protect your trading capital from excessive losses. 4. Stay disciplined. Stick to your trading plan and follow your predefined rules consistently, even when faced with emotional impulses or market fluctuations. Discipline is a grip for a long-term success in trading. 5. Manage expectations. Maintain realistic expectations about trading outcomes and understand that losses are an inevitable part of trading. Avoid chasing unrealistic gains or succumbing to the fear of missing out. 6. Focus on process over outcome. Shift your focus from short-term results to the quality of your trading process. Evaluate your trading decisions based on their alignment with your trading plan and strategy, rather than solely on their immediate outcomes. 7. Practice patience. Cultivate patience and wait for high-probability trading setups to align with your criteria before entering trades. Avoid impulsive trading decisions driven by emotions or a desire for immediate gratification. 7. Continuous learning. Commit to ongoing learning and improvement as a trader. Stay updated on market developments, study trading strategies and techniques, and analyze your trades to identify areas for growth and refinement. Surround yourself with a supportive trading community or mentorship network. Sharing experiences, seeking advice, and receiving feedback from fellow traders can provide valuable emotional support and perspective. By adding these trading psychology ideas into your trading mindset, you will develop the mental resilience, emotional discipline, and psychological skills which you need to overcome the challenges of trading successfully over the long term. If you need a Forex mentor that will personally guide and mentor you one-on-one, check the description box below for a link into his Telegram channel. By following all the rules, strategy and psychology you have received in this video, in a very short time you will begin to notice how profitable you will become as you follow them and practice them more. It will make you millions in the best time to come. In our next video, I will be teaching a complete full course on order blocks, smart money concepts, and how to trade with the big banks. Subscribe to this channel right now so you don't miss out on it and other future strategies.